Welcome back to another explainer. Let's just jump right in today. If you've spent any time at all looking at the stock market, you know the basic metrics, right? The good old PE ratio, things like that. But here is the hard truth we pulled from our source material today. Relying just on those basic numbers often creates an illusion. They give you this nice, simple, surface-level picture that can completely hide a company's true reality. So today, we're taking out the magnifying glass. We are going to look past the surface and uncover the real, advanced toolkit for stock valuation.
So, let's start with a question. Is a high return on equity, or ROE, always a good thing? I mean, your gut reaction is probably, yeah, higher returns are obviously better. But what if I told you that a sky-high ROE could actually be a massive, glaring red flag that a company is literally drowning in debt? Yeah, today we're going to make you question what you think you know about supposedly good financial numbers. Here is our roadmap for today. 1. Beyond basic stock metrics. 2. Decoding enterprise value. 3. The price-to-book truth. 4. Profits versus actual cash flow. 5. Breaking down ROE. And finally, 6. Finding true financial health.
Section 1. Beyond basic stock metrics. The illusion of the surface.
Section 2. Decoding enterprise value. The true price tag.
Usually, when people want to figure out what a company costs, they just look at market capitalization, right? Just the share price multiplied by the number of shares. But honestly, market cap alone doesn't show you the real price tag of a business. Let's use a super simple shop analogy. Imagine you want to buy a local shop, and the owner asks for $100. That's your market cap. But you open the shop safe, and boom, there's $20 in cash inside that becomes yours the second you buy the place. So really, the shop has only cost you $80 out of pocket so far. But wait, the shop owner actually owes a friend $10. And as the new owner, guess what? You have to pay that debt. So you add that $10 back on. Your true final cost to take over this business is $90.
And that brings us to enterprise value, or EV. The formula is literally just that. Market cap minus cash plus debt. This metric represents the true absolute total cost to acquire a company. And look, why does this matter so much? Because it protects you, the investor, from overpaying for a business that might look incredibly cheap on the surface, but is actually weighed down by massive hidden loans. Let's look at a real-world example from the data. Ad Labs Entertainment, the company behind the Imagica theme parks. Now, if you strictly looked at their market cap, you might think you were getting an absolute bargain. But the second you factor in their high hidden debt using enterprise value, it radically changes the actual value of the business. Debt heavily distorts the perceived value, and EV cuts right through that illusion like a hot knife through butter.
Section 3. The price-to-book truth. Asset-heavy versus asset-light. Let's contrast two entirely different types of businesses. First, heavy industries. Think cement manufacturers or power companies. These businesses require huge capital for hard assets, land, massive factories, heavy machinery. All of that sits right there clearly on the balance sheet, which makes the price-to-book ratio a fantastic tool. But then, consider modern asset-light businesses like InfoEdge or Zomato. They don't have massive factories. Their biggest assets literally log off and go home at 5 p.m. It's their employees. And under standard accounting rules, human capital is just recorded as an expense, not an asset.
Because of that quirky accounting rule, an asset-like company like InfoEdge can sit there with a price-to-book ratio of 10x. Now, if you didn't know the context, you'd see 10x and run for the hills thinking it's insanely expensive. But it's a total illusion. For modern tech companies, their real engine of value generation, their human capital, isn't even captured on the balance sheet. So the crucial takeaway here is never, ever blindly use price-to-book for asset-light businesses. It just doesn't work.
Section 4. Profits versus actual cash flow. The ultimate truth teller.
Let's talk about the price-to-cash flow ratio. This simply compares a company's market value directly to its operating cash flow. Why is this an absolute game changer? Well, because a company can easily massage its accounting profit. They can legally record a massive sale before a single dime actually arrives in the bank. It's paper profit. But cash flow, you cannot manipulate cash. Cold, hard cash coming into the bank cuts right through the accounting noise. It is the ultimate reality check. This is also exactly why understanding a company's cash conversion cycle is absolutely critical. You really want to measure how fast a company can actually convert its investments in inventory and resources back into real cash in the bank.
Let's look at a direct comparison to make this concrete.
Here we have Bajaj Consumer trading at an 11x price-to-cash flow ratio and Jyothi Labs trading at a slightly pricier 12x ratio. How do you decide which is better? Well, as our sources point out, you have to layer on the context of brand strength. Are you willing to pay 11 times cash flow for Bajaj's almond drops and no marks, or would you rather pay that slight premium of 12 times cash flow for Jyothi Labs' amazing portfolio of Ujala, Maxo, and Margo? You use the cash flow as the base reality and brand strength to make your final call.
Section 5. Breaking down ROE. Looking under the hood.
Enter the DuPont analysis. This brilliant tool breaks ROE down into 3 distinct parts: net profit margin, asset turnover, and the leverage multiplier. It's literally like popping the hood of a used car. You find out why the ROE is what it is. Is the company generating high returns because their profit margins are fantastic? Or are they incredibly efficient at turning assets into sales? Or, and here's the scary part, is their high ROE simply being driven by the leverage multiplier, meaning debt? If ROE is shooting up purely because a company is taking on massive loans, that is a screaming red flag.
Let's look at the danger of this using Symphony's return on equity as a timeline. Check out those early years: 44%, 41%, 45%. I mean, on paper, that looks incredible, right? Most investors would trip over themselves to buy in. But then, look what happens. Year 4, it drops to 34%, and by year 5, it completely falls off a cliff down to 15%. What on earth happened? Why did this seemingly amazing company suddenly crash?
Well, here is the reality the DuPont analysis revealed. Symphony's ROE didn't drop because they responsibly bought new assets for future growth. Nope. By breaking down the numbers, the data showed that their asset turnover was plummeting, which was actually masking a severe 23% drop in their real actual sales. The underlying business was fundamentally struggling to sell products, and that shiny initial high ROE was completely hiding the vulnerability.
Section 6. Finding True Financial Health. The Final Verdict.
So let's bring it all together. Here is your advanced toolkit recap. First, always use enterprise value to find the true price tag of a business. Factor in the cash and the debt. Second, remember that price to book is a great tool, but keep it strictly for asset-heavy industries. Don't let tech companies trick you. Third, when in doubt, trust actual cash flow over easily manipulated paper profits. And finally, never take return on equity at face value. Break it down using DuPont analysis to spot hidden debt or dropping sales. This is exactly how you avoid those classic value traps.
I'll leave you with this final provocative thought. Are your investments built on real cash flow, or are they just built on accounting illusions? Look, now that you have this advanced toolkit, you can look at the market through an entirely new lens. Go out there, apply these secrets to your own research, and uncover the reality hiding behind the numbers. Thanks so much for learning with me today on this Explainer, and I'll see you next time.
Welcome back to The Explainer. Today, we're taking a hard look at financial ratios, busting a few massive profitability illusions, and then applying a totally unique lens to the wild, upside-down world of banking stocks. Picture this. You're screening stocks, and you spot a company pulling a massive 40% return on equity. Your first instinct? Probably to buy in right away, right? I mean, it looks like a golden ticket. But what if I told you that shining metric might actually be a giant trap hiding a portfolio-destroying risk? Today, we're going to learn exactly how to spot that trap and look way past the surface-level numbers. Here is our game plan. We're going to cover 1, the profit illusion, 2, ROE versus ROCE, 3, the banking exception, 4, decoding banking ratios, 5, measuring bank risk, and 6, the ultimate banking checklist. Let's get right into it. Part 1. The profit illusion. So, to understand this illusion, let's look at why you absolutely cannot blindly trust a high return percentage. Say we have 2 businesses, and they both earn the exact same profit of 40 rupees. In scenario A, you invested 200 rupees of your own hard-earned cash. That gives you a solid return on equity, or ROE, of 20%. Not bad. But now look at scenario B. Here, you only put in 100 rupees of your own money, and you borrowed the other 100 from a friend. Because you only used 100 of your own equity, your ROE suddenly doubles to 40%. The businesses are identical in actual profit, but that second one is heavily leveraged. And this is exactly how debt warps returns. A company can artificially inflate its ROE just by taking on massive, risky debt. Since ROE only measures the return on the shareholder's equity, if a company replaces its own money with borrowed money, the equity base shrinks, and the math Well, it automatically spits out a much higher ROE percentage. It's a complete mirage. A 40% ROE might look like a brilliantly run business, but in reality, you might be looking at a company drowning in debt and literally one bad quarter away from going bust. Moving to part 2, ROE versus ROCE. To slice right through that debt illusion, we need a sharper tool. Enter ROCE, or Return on Capital Employed. The beauty of ROCE is that it strips away the accounting tricks. It measures the return on the total money deployed in the business, so both the owner's share and the borrowed debt. Going back to our example, whether you use 200 of your own cash or 100 yours and 100 borrowed, the total capital employed is still 200. ROCE looks at that total, leveling the playing field so you can easily see if the core business is actually a cash-generating machine or just playing around with leverage. All right, part 3, the banking exception. Now I want you to take everything we just established about debt being dangerous and completely flip it upside down. For banks, taking on debt isn't a red flag at all. It's literally the raw material they need to survive. Think about it. When you put your money into a savings account, you are effectively giving the bank a loan. That deposit is their debt. So a bank with no debt is a bank with no deposits. And a bank with no deposits, well, that's a bank with no business. The bank's playbook is wonderfully simple at its core. Step 1, they borrow money from you, dirt cheap, say around 4% on a fixed deposit. Step 2, they turn right around and sell that exact same money to someone else, maybe a business or a home buyer, at a steep premium, like 12%. And step 3, they just pocket the difference. That 8% margin is their profit to cover operations and pay out to shareholders. Which brings us to part 4, decoding banking ratios. Since banks run on an entirely different operating system than your standard tech or manufacturing stock, we need a highly specialized toolkit to evaluate them. Standard metrics just don't cut it. The absolute lifeblood of a bank is cheap money, and that's where the CASA ratio comes in. CASA stands for current accounts and savings accounts. Current accounts usually pay out absolutely zero interest, and savings accounts pay around 2.5 to 3%. This is the cheapest raw material a bank can get their hands on. If a bank can fund its operations primarily through CASA instead of locking in expensive 7% fixed deposits, they have a huge competitive advantage. So the higher the CASA percentage, the better. Take Kotak Mahindra Bank from a few years ago. By aggressively pushing a juicy 6% interest rate on savings accounts, they lured in a massive wave of customers. This genius move pushed their CASA ratio to a staggering 52%. That means more than half of their total deposits were incredibly cheap to maintain. Even though they paid a bit more upfront on the savings rate, securing that much CASA fundamentally strengthened their entire deposit base. So after a bank secures all those cheap CASA deposits and lends them back out, we track the NIM, or net interest margin. This metric is the bottom line. It tells us exactly how efficiently the bank is pocketing the difference. If a bank consistently maintains a high NIM, it means they've got serious pricing power. They're charging premium rates on their loans while keeping their deposit costs rock bottom. Let's hit part 5, measuring bank risk. Look, handing out loans at high interest rates is easy. Getting that money back, that's where the real art of banking is. Knowing who will actually repay a loan brings us to NPA, or non-performing assets. These are loans that have gone totally sour because the borrowers stopped paying. It is the ultimate danger metric. If a bank gets greedy and hands out shady loans just to juice their net interest margin, it will inevitably show up here as a massive spike in bad loans. You want to see that net NPA percentage kept as close to absolute zero as humanly possible. HDFC Bank is pretty legendary for this. They maintain a consistently low net NPA of around 0.39%. That one single metric speaks volumes. It proves their lending standards are practically bulletproof. They aren't just chasing wild growth, they are chasing quality growth, making sure the money they send out the door actually makes it back to the vault. But what happens if a recession hits and even the good loans go bad? That is where CAR steps in, the capital adequacy ratio. Think of this as the bank's ultimate emergency shock absorber. It's the core capital they hold specifically to absorb losses from bad loans before facing bankruptcy. Regulators mandate a minimum CAR for sure, but the truly great banks hold well above that limit so they can weather any economic storm without breaking a sweat. Now, when we zoom all the way out to evaluate the bank's overall performance using everything it has, its loans, investments, cash, we look at ROA, return on assets. In the banking world, hitting a 2% return on assets is basically the holy grail of operational excellence. Because banks hold such a massive scale of assets, generating a clean 2% return across the board tells you you're looking at a highly efficient, well-oiled machine. Finally, part 6, the ultimate banking checklist. All right, this is your ultimate screenshot moment. We are pulling all these threads together into a single killer framework. If you want to analyze banks like a pro, plot 8 to 10 banks against these exact metrics: price to book, CASA percentage, ROE, ROA, net NPA, NIM, CAR, and advances growth. Putting them side by side completely removes the guesswork. You'll instantly see who leads the pack in cheap deposits, who's got the safest loan book, and who is actually generating the best returns. And here is the secret strategy for finding an undervalued gem. Once you've plotted those metrics, you are hunting for anomalies. You want a bank that absolutely crushes it on CASA, hits that near 2% ROA, and keeps their NPAs next to zero. Then, you cross-reference those stellar fundamentals with their valuation, specifically the price-to-book ratio. If you find a bank with top-tier metrics but it's trading at a noticeably lower price-to-book ratio than its peers, well, you might have just stumbled onto a severely undervalued asset. So, armed with this 8-column matrix and your new X-ray vision for banking balance sheets, it's time to play financial detective. Which hidden gem in the banking sector are you going to uncover next? Get into the numbers, build your matrix, and see what you find. Thanks for joining me on this explainer, and I'll see you in the next one. Namaste, everyone, and welcome. Today, we're diving deep into a real cinematic investigation of the stock market. You know, a lot of people hear stock market and instantly panic. We've all seen those movies where the market crashes and everyone loses everything, right? Or maybe your relatives told you to just stay far, far away from it. But today, we're totally demystifying complete stock market fundamental analysis. We're going to uncover exactly how simple, everyday common sense can actually beat out those super complex finance degrees. Think of this as your personal detective toolkit for building real wealth. To kick off our investigation, just look at this massive number. This is a real historical fact, by the way. If someone in your family had invested a mere 10,000 rupees in Wipro 40 years ago, maybe even before you were born, that tiny investment would be worth a staggering 700 crore rupees today. Literally. Even if they had only put in 100 rupees, it would still be worth 7 crores. That right there is the immense, undeniable potential of the stock market. It's not about gambling for overnight riches, guys. It's about giving great businesses the time they actually need to grow. Now, let's shatter probably the biggest myth in finance, the idea that you absolutely need a commerce degree to succeed. No way. There was this really fascinating study done in the US where a group of 10-year-old kids was asked to pick a basket of stocks. At the exact same time, a group of highly educated chartered accountants picked their own basket. And guess what? 5 years later, the kids actually outperformed the financial experts. Why? Because the kids just picked companies whose products they used and loved, like Disney or their favorite chocolate brands. They understood the businesses. Meanwhile, the accountants got totally lost in complicated spreadsheets. You don't need to be a math genius for this stuff. You just need to understand basic consumer behavior. Section 1, the power of investing and the compounding formula. Let's dive right into this. If we want to capture that massive growth potential without just relying on blind luck, we need a system. We need the exact formula that turns small, consistent savings into massive wealth. You absolutely do not need a massive lump sum to get rich. Just take a look at these 4 really simple steps. Step 1, start with just 1,000 rupees a month in an SIP. Step 2, every single year as your income grows, increase that monthly investment amount by just 15%. Step 3, aim for a totally realistic return of around 15% by picking a solid basket of stocks. And step 4, just wait 25 years. If you follow those steps, that super modest starting point literally turns into 1 crore rupees. The secret isn't timing the market perfectly. It's consistency, it's time, and it's letting compounding do all the heavy lifting for you. Section 2, cracking core valuation ratios, or as I like to call them, the financial clues. Now that we know the math behind staying invested, what do we actually buy? Think of this phase as gathering our clues to investigate a company's true worth. Our very first clue is market capitalization, or just market cap. Simply put, this is the total price tag of the entire company if you wanted to buy 100% of it today. So, say you have 5 lakh crores to spend. Would you rather buy all of Hindustan Unilever or all of Infosys? It's a fun thought experiment, right?
Looking at the market cap helps you instantly grasp the true size and scale of a business and intuitively gauge exactly where you're putting your hard-earned money. Next up is the PE ratio, which stands for price to earnings. This basically tells you the multiplier you're paying for just one single year of a company's profits. Let's ground this with a super simple question. Would you buy a local shop for 70 rupees if it only gave you 1 rupee of profit a year? Obviously not, because it would take you 70 years just to make your money back. So, if a company has a PE of 70, you're paying 70 times its current annual earnings. It is an absolutely vital clue to figure out if a stock is currently cheap or just wildly expensive. But hey, market cap doesn't tell the whole story. And that brings us to enterprise value, which is the true effective cost of a business. Let's go back to that shop analogy. Imagine you buy a shop for 100 rupees. That's your market cap. But when you walk inside, you pop open the cash register and boom, you find 20 rupees sitting right there. Amazing, right? So the shop effectively only cost you 80 rupees. But wait, the previous owner left a sticky note saying you owe a supplier 10 rupees. So 80 plus the 10 you owe makes your true cost 90 rupees. That 90 rupees is your enterprise value. It accounts for the cash a company holds and the debts it owes, giving you the real ultimate price tag. Section 3, identifying a business moat, or the fortress. Moving forward in our investigation, we need to look for this fortress. A moat is basically that competitive advantage that protects a business from being completely destroyed by its rivals, and this brilliantly illustrates what happens when you completely ignore the economics of a moat. Look at this comparison between Imagica and Wonderla, 2 amusement parks right here in India. Imagica tried to build this super premium Disneyland model. They poured a massive 16 to 1700 cores upfront into grand waterfalls and huge indoor rides. But because average consumers just couldn't afford those Disneyland-level ticket prices, it's going to take Imagica over 14 years just to earn back their initial investment. Wonderla, on the other hand, built a lean, local fare model. They packed a smaller area with tons of rides, and it only cost them about 350 crores. Their payback period? Just around 5 years. Wonderla's smart, low-cost capital structure is just an incredible advantage.
So as a stock market investigator, what are the common fortresses you should actually be looking for? Well, first is government protection or exclusive licensing. Think about credit rating agencies, right? The government heavily restricts new licenses there. Second is a low-cost production advantage, where a company literally owns its raw materials. Imagine a cement company that actually owns its own limestone mine. Huge advantage. And third is high upfront capital. Just like we saw with Wonderla, once you establish a profitable park in a city, that massive upfront cost acts as a huge barrier. It basically prevents new competitors from even wanting to open a park right next door.
Section 4, investigating banking stocks, the specialized case. Okay, now we have to talk about a very unique corner of the market. When you're investigating banks, you basically have to throw out your standard industrial valuation ratios. Because banks don't make physical products, right? Money is their raw material. So what's the actual difference between a traditional bank and a non-banking financial company, or an NBFC? Well, think of a bank as a massive wholesale vegetable market. Because banks can open current and savings accounts, they get money very, very cheaply, practically at wholesale rates. An NBFC, though, is more like the vendor pushing a cart door to door. They can't accept standard deposits, so their funds cost a lot more. But they bring the convenience of loans directly to people that the big banks might just completely ignore. So what are the absolute non-negotiable clues you need when looking at a bank? Here is your rapid-fire checklist. First, you want a high CASA ratio. This just means a large chunk of their money comes from cheap current and savings accounts. Second, you want an ROA, or return on assets, hovering right near a highly efficient 2%. Third, you absolutely must see low NPAs, or non-performing assets. That simply means people are actually paying back their loans. And finally, strong capital adequacy, which ensures the bank has enough of a buffer to survive tough economic times. Honestly, never buy a banking stock without checking these boxes first. But hey, you have to remember that evaluating financial statements and just staring at numbers on a spreadsheet won't ever tell you the whole story. A true stock market detective always reads the management commentary and the risk factors in a company's annual report. Why? Because this is where the company legally has to tell you exactly what could destroy their business. Whether it's raw material costs spiking, new fierce competition, or some sudden change in government regulations, this section reveals all the hidden threats that standard valuation ratios are going to completely miss. So, what does this all mean for you? We've arrived at the ultimate question for your financial future. When it comes to your hard-earned money, are you going to blindly follow the crowd, desperately trying to get rich overnight on random tips and sketchy rumors? Or are you going to put on your detective hat, investigate the fundamentals, check the valuation ratios, and identify those solid business moats? The power to grow your wealth isn't locked behind some fancy, complex finance degree. It's right there, in the common sense clues just waiting to be discovered. Thanks for hanging out with me for this investigation, and happy investing.
Welcome to The Explainer. You know, when we look at the stock market, surface-level numbers can be incredibly persuasive. But here's the thing. They often completely lie to us. They literally trick our brains into making, well, terrible financial decisions. But what if you could look past those superficial numbers? What if you had a kind of X-ray vision to instantly spot true business health? That is exactly what we're building today. We're going to decode the fundamental realities of investing.
Think of this agenda as your investor's X-ray toolkit. We've got 5 hidden metrics to uncover today. 1. The face value illusion. 2. The profit margin paradox. 3. Predicting short-term survival. 4. Decoding bank profitability. And 5. The qualitative bank check. Let's get right into it.
Okay, let's dive into this. Section 1. The face value illusion.
So the first, and honestly probably the most common illusion that traps amateur investors, is misunderstanding face value. It's the ultimate trap of thinking something is a bargain just because the price tag is a tiny number. Let me ask you, is it 2.5 rupee stock truly cheaper than a 56,000 rupee stock? Look, if you just glance at the share price, your instinct probably screams yes. You're thinking, wow, if that 2.5 rupee stock just goes up a couple of bucks, I've doubled my money. But let's see how this mental trick actually plays out in reality.
And this brilliantly illustrates the trap. You might see Ad Labs trading at a tiny 2.5 rupees. And then, right next to it, you look at MRF, the massive tire manufacturer, trading at a staggering 56,000 rupees. But look closely at their face value. They are both exactly 10 rupees. See, face value simply shows how a company's initial capital was mathematically chopped up into pieces on day one. It has absolutely zero, literally no correlation to whether the stock is heavily overpriced today or a hidden bargain. Think about it like a unit of weight. Say you've got 10 grams of iron. That might cost you 1 rupee. But 10 grams of gold? That's going to run you 4,000 rupees. The weight, the 10 grams, is totally identical. Just like that 10 rupee face value for both Ad Labs and MRF. But the intrinsic value of the underlying material is worlds apart. MRF shares are sky high because the underlying business is like gold, not because it was split up differently. So the rule here? Never ever buy a stock just because the face value makes the current price feel cheap.
Moving right along. Section 2. The profit margin paradox.
Let's transition to the actual engine of the business. Now, we've all been taught that higher profit margins are always better, right? It makes sense. But in fundamental investing, this is actually a massive paradox. See, if you operate a business with massive, sky-high margins, you are basically painting a giant target on your back. High margins invite incredibly aggressive competitors who want a piece of that action. Just think back to the telecom sector a few years ago. Companies were making huge margins on data and calls. And what did that do? That high-margin environment directly invited Jio to crash the party, slash prices, and completely destroy the competition. On the flip side, low margins can be incredibly powerful. Take DMart, for example. They purposefully operate on razor-thin margins. Why? Because by offering rock-bottom prices, they sell in massive volumes. This low-margin approach acts as an impenetrable moat. No competitor wants to enter a space where they have to fight for absolute pennies on the dollar just to survive.
Now, what's really interesting about this is the math behind it. Take Eicher Motors, the guys who make Royal Enfield. They have a fantastic profit margin of 20% and a really solid return on equity of 24%. But then consider Page Industries, who make jockey apparel in India. Their profit margin is much lower, sitting at 13%. They earn way less per item sold. Yet, because of their massive volume and the sheer velocity of their sales, their return on equity is nearly double that of Eicher. It's crazy, right? A business earning less margin per item can actually generate drastically higher returns on your invested capital.
All right, Section 3, Predicting Short-Term Survival.
So we've talked a lot about making money, but what about simply surviving? Because, believe it or not, even highly profitable companies can and absolutely do go bankrupt if they can't pay their immediate bills. And this is exactly where the quick ratio comes in. It is your ultimate lie detector test for short-term survival. Imagine a company gets hit out of nowhere with an emergency, maybe a sudden economic downturn or a big debt payment gets called in early. The quick ratio tells you if they have enough purely liquid assets, like cash and short-term investments, to pay off those immediate liabilities. And notice, we completely exclude inventory here. Why? Because in a sudden emergency, you can't just magically liquidate a warehouse full of unmade products overnight. So,
The crucial point is this golden rule. Your quick ratio must be greater than 1. It's that simple. This means that for every single dollar of short-term debt a company owes in the near future, they have more than $1 of liquid cash ready to deploy instantly. If this number dips below 1, that company is walking a tightrope, risking a severe liquidity crisis.
Let's shift gears a bit. Section 4, decoding bank profitability. Okay, so everything we just discussed about margins and debt, throw it completely out the window when we talk about banks. Standard metrics like debt to equity simply do not work here. Why? Because taking on debt, which is basically just your savings deposits, is literally their entire business model. To look inside a bank, we need a totally different X-ray machine. So let's look at the first critical metric for banks, net interest margin, or NIM. Imagine a bank gives out a loan and charges 12% interest, but to get the cash for that loan in the first place, they took your deposit and paid you 5% interest. The difference there, the spread, is 7%. But wait, they can't loan out all that money. They have to keep some parked in reserve with the central bank. So the NIM calculates the pure percentage of interest the bank actually gets to keep in its pocket after all those payouts and mandatory reserves are fully accounted for.
And what does a genuinely good NIM look like? It's 4%. In the banking sector, hitting a 4% net interest margin is an absolutely exceptional benchmark. Historically speaking, top-tier, highly efficient institutions, think along the lines of HDFC Bank, have consistently operated right near this exceptional 4% mark. It just proves their massive efficiency in juggling deposits and loans.
Now, the second banking metric we need is return on assets, or ROA. To wrap your head around this, just remember how a bank works fundamentally. Your deposits are their liabilities because, well, they owe you that money back. The loans they give out to businesses and home buyers, those are their assets because those loans are what actually generate income. The ROA tells us exactly how much pure profit a bank is generating directly from those loan assets.
In the banking world, hitting a 1% ROA is pretty much considered the absolute bare minimum survival benchmark. If a bank is sitting below 1%, they are definitely struggling. But hitting near a 2% ROA, again, looking at HDFC historically sitting around 1.83%, that is the gold standard of banking excellence. It basically tells you the bank is incredibly smart about who they're lending to and exactly how they manage their day-to-day operating costs.
Finally, Section 5, the qualitative bank check.
Now, investing isn't just about staring at spreadsheets and crunching raw math. We also need to perform a qualitative health check. Why? Because these soft factors are exactly what keep a bank truly resilient during an economic meltdown. First off, a highly rated bank desperately needs granular deposits. You absolutely do not want a bank relying on just two giant corporate billionaires for all their deposit money, because if those two guys get spooked and withdraw their funds, the whole bank collapses. You want thousands and thousands of small retail accounts, just everyday people's savings. Secondly, they need a diversified loan book. You literally cannot lend all your money to just farmers or just the real estate sector.
Let's move to and see how this builds a safety net in practice. Consider what ideal diversification really looks like. If a bank spreads its loans evenly, say 20% in homes, 20% in auto, 20% in agriculture, 20% corporate, and 20% personal, they severely protect themselves. Because think about it, if the auto sector completely crashes and folks stop paying their car loans, the bank doesn't die. It still thrives on the remaining 80% of its perfectly healthy portfolio. This level of diversification is your ultimate qualitative safety check.
So as we wrap up this explainer, I really want to leave you with this one crucial question. Are you buying the illusion, or are you investing in the reality? Are you still getting tricked by low face values, or maybe distracted by those dangerously high profit margins? Look, the next time you analyze a business, don't just stare at the shiny service numbers. Apply this X-ray toolkit we just built. Look for the true liquid survival ratios, the structural moats, and the real mechanisms driving that balance sheet. Keep learning, keep analyzing, and I'll see you in the next explainer.
Okay, picture this. It's exactly 40 years ago. Someone in your family takes just 10,000 rupees. Maybe you weren't even born yet, right? And they invested in this company called Wipro. And then they just forget about it. They leave it completely alone. Well, if they did that, today, that mere 10,000 rupees would be worth, wait for it, a staggering 700 crore rupees. I mean, just let that sink in for a second. That right there, that is the mind-blowing, almost incomprehensible potential of the stock market when you get it right.
So, welcome to the explainer. Today, we're basically stripping away all that fear, the intimidating jargon, and all those ridiculous myths surrounding investing. You know, people so often think the market is just this chaotic gamble, a casino where only the big Wall Street insiders actually win. But what if I told you that uncovering the real financial truth doesn't require complex spreadsheets? It actually relies way more on just plain, everyday common sense.
Okay, let's dive into this, because there was this completely fascinating study in the US. They actually pitted a group of 10-year-old fifth graders against a team of top-tier, highly educated chartered accountants, just to see who could build a better stock portfolio. Now, the financial experts, they obviously pored over complex balance sheets, sophisticated ratios, the whole shebang. But the 10-year-olds, they literally just picked the brands they already used and loved every day. Disney, Barbie, Cadbury. Fast forward 5 years, and no way. The kids completely outperformed the experts. Why? Because those kids actually understood ground reality. They knew exactly which products were truly satisfying customers right now. It just goes to show that sometimes simply observing the world around you absolutely beats out any fancy financial formula.
All right, let's get right into Chapter 1, the magic blueprint of wealth.
So how exactly do we take that kind of practical observation and turn it into a real workable strategy? Well, the good news is you definitely do not need a finance degree to build a fortune. You really just need to understand this secret mathematical weapon that just quietly works in the background. I'm talking about compounding. Let's look at a massive, seemingly impossible milestone, 1 crore rupees. For most ordinary folks just starting out in their careers, saving up a crore feels like a total pipe dream, right? But let's actually break down how achievable this really is, and without taking on crazy, reckless risks either.
It literally boils down to just 3 simple rules. Step 1. You just start by investing 1,000 rupees a month. That's it. Step 2. Every single year as your career progresses and you get those salary bumps, you just increase that monthly investment amount by 15%. And step 3. Aim to earn a 15% annual return on those investments. Honestly, if you just stick to this incredibly basic discipline for 25 years, you will hit exactly 1 crore rupees. That is the absolute sheer power of compounding over time. It's not magic, guys. It's just math.
Which brings us to Chapter 2, the amusement park illusion.
Now, to actually get those consistent returns, you've got to know how to spot a genuinely good business. And to explain this, let's look at one of my absolute favorite case studies. It's a tale of 2 drastically different amusement parks, Imagica and Wonderla. Now, what's really interesting here is the massive contrast in their initial capital. Imagica had this incredibly grandiose vision, right? They basically wanted to be the Disneyland of India. We're talking massive waterfalls, huge animatronics, these super elaborate indoor themes. The initial cost for all that? A staggering 1,700 crore rupees. But then, on the flip side, you have Wonderla. They had a much more grounded vision. They realized, hey, people mostly just come here to go on the rides. So they just built a solid, ride-focused amusement park for a fraction of the cost, just 350 crore rupees.
Now, why does this massive difference in cost matter so much? Well, it all comes down to this absolutely crucial financial concept called the payback period. For a highly asset-heavy business, like an amusement park, where you literally have to sink in hundreds of crores before you even sell a single ticket, the payback period is basically your ultimate test of survival. It's simply the amount of time it takes for a business to recover its initial investment strictly from the net cash it generates.
And man, here is the crushing blow of those 2 very different visions. Because Imagica spent 1,700 crores, but realistically can only charge Indian consumers maybe 1,000 to 1,500 rupees a ticket, it's going to take them roughly 14 long years just to recover that initial investment. I mean, they're totally trapped for over a decade just trying to break even. Wonderla, on the other hand, because they kept their initial cost to just a quarter of Imagica's, they get their entire initial investment back in just 5 years. After that, they're totally free to use all that cash to rapidly expand and start building new parks.
And Wonderla didn't just win on the initial build either. They optimized absolutely everything. For instance, by combining their water and amusement park tickets, they could efficiently share staff and resources depending on where the crowds were flowing. Also, having no grandiose, over-the-top themes meant significantly lower land costs. And here's a real game changer. They actually manufacture a lot of their rides in-house. That means they completely sidestep all those hefty government import taxes that other parks are forced to pay when they buy rides from overseas. It just proves that smart practicality utterly destroyed the expensive, flashy illusion.
Moving on to Chapter 3, Hiding in Plain Sight.
You see, not every illusion is as easy to spot as a massive, expensive waterfall. Sometimes, companies can hide their true financial scale and their actual health right in plain sight on their financial statements. And there's a great example that brilliantly illustrates this. If you just glance at Tata Motors' standalone statement, you might see sales sitting around 70,000 crore.
Sounds big, right? But if you dig deeper and pull up their consolidated statement, which includes their massive subsidiary Jaguar Land Rover, their total sales explode to over 3 lakh crore. It's wild. If you're only looking at the standalone numbers, you are getting a completely fragmented, totally false picture of how massive that entity actually is.
We also run into this issue where we need to accurately compare companies of completely different sizes. That's exactly where a common size statement comes to the rescue. Take a massive, sprawling entity like HDFC Bank and try comparing it to a much smaller, newer bank. You really can't just compare their raw profits. It doesn't make sense. But if you normalize their base interest earned to 100%, suddenly everything becomes crystal clear. You can see exactly what percentage of that 100% is being burned on operating expenses, what's getting eaten by taxes, and what actually trickles down as net profit. It completely strips away the illusion of size and reveals their pure underlying operational efficiency.
All right, let's jump into Chapter 4, the mirage of quarterly numbers.
So every 3 months, we see stock prices violently swing based on these short-term quarterly reports. But are they really telling us the whole truth? Let's actually look back at Wonderlove for a second. If their sales suddenly drop in a specific quarter, does it automatically mean the business is failing? Well, not necessarily. Just think about the timeline of a typical year. If it happens to be exam season, obviously students aren't going to theme parks. Or if it's the monsoon season, nobody is going on outdoor roller coasters. But then April to June hits, the summer spike arrives, and boom, the water park is absolutely packed. You really have to understand the natural seasonality of a business before you start panicking over a temporary quarterly drop.
So it really makes you pause and ask yourself, do these results always speak the absolute truth? Or could they sometimes be manipulated to trick unsuspecting retail investors?
Well, let's move along and see how this builds into a very real, very deceptive little trick some companies use. Step 1. A company might do something called stuffing the channels. This is where they aggressively ship out excess inventory right at the very end of the quarter just to artificially inflate their sales numbers on paper. As a result, the stock price shoots up. Step 2. Insiders at the company, who totally know those sales are inflated, sell off their shares at this new peak price. Step 3. The next quarter rolls around. All that unsold inventory gets returned, sales naturally plummet, and the stock price crashes. Step 4. Those same insiders simply buy their shares back at a much, much cheaper price. It's honestly a scandalous mirage.
So, how do you actually protect yourself from all these paper manipulations? Well, you look directly at the cash flow from operations. This right here is our ultimate lie detector. See, net profit on a P&L statement, that can be adjusted, delayed, and entirely fudged with clever accounting tricks. But you literally cannot fake actual cold hard cash hitting the company's bank account. If a company is out there claiming massive net profits, but their cash flow from operations is drastically lower or even negative, yeah, that is a glaring, massive red flag.
Which brings us to our final chapter, the ultimate currency.
We've conducted quite a bit of financial forensics in this explainer, haven't we? But if you take away anything, the crucial point is this. What you see on the surface is rarely the whole truth. Take promoter holdings, for example. It looks absolutely great on paper when founders own a huge chunk of stock. It shows confidence, right? But what if they are secretly pledging those shares? Promoter pledging basically means they are using their own shares as collateral to get loans. If the stock price suddenly drops, the banks can forcefully sell those pledged shares to get their money back, which crashes the price even further. So dazzling quarterly numbers or these grandiose visions can project incredible confidence. But if you aren't checking for hidden risks, like pledged shares, real cash flows, and actual payback periods, that confidence is just a dangerous illusion.
You now have the blueprint. You know exactly how to look past the grand themes, how to completely ignore the seasonal noise, and how to track the actual hard cash. Investing isn't a chaotic gamble if you actually know where the traps are hidden. So, the real question is, now that you're armed with the truth, will you let the market's illusions fool you ever again? Welcome to today's Explainer. We're going to look right past the smoke and mirrors of the stock market. If you've ever felt intimidated by all that complex financial jargon, or maybe you've secretly wondered if the market is just a giant casino designed to confuse you, well, you are in the exact right place. Today, we're going to unmask 4 massive market illusions using pure fundamental analysis. The goal here is simple, to help you make decisions based on cold, hard facts, not fiction.
So let's jump right in with a massive mythbuster. Are bonus shares actually a bonus? I mean, just hearing the word bonus makes it sound like a company is handing you free money, right? Who doesn't love a bonus? Well, keep that thought in the back of your mind, because the reality of how this actually works is about to completely change how you view corporate announcements.
Here's our quick agenda for today's explainer. We're going to shatter 4 distinct illusions. 1. Corporate actions. 2. Annual reports. 3. Banks versus NBFCs. And 4. IPO market impact.
All right, let's get into illusion number 1, corporate actions and the whole free money myth. There is this super common belief out there that corporate actions like stock splits give retail investors instant value. But let's take a step back and think about the actual definition of a stock split. It absolutely doesn't magically make you richer. It's literally just a math trick. Companies simply divide their shares to make highly priced stocks a bit easier for retail investors to buy, which increases liquidity. But your total invested value? That stays exactly the same.
Let's look at a real-world example to make sense of this. Think about TCS back in 2004. Before their split, you had one share with a face value of 10 rupees. After the split, that single share became 10 shares, but each one now had a face value of just 1 rupee. So sure, you hold 10 times the number of shares, but your actual slice of the company hasn't changed by a single fraction. It's exactly like cutting a pizza into more slices. You don't magically get more pizza, you just have smaller slices.
And you know what? This exact same illusion applies to bonus issues. Despite the wonderful, exciting name, when a company issues bonus shares, the company itself receives absolutely zero new money. Because the underlying funds haven't changed at all, but the number of shares has artificially doubled, your per-share book value simply drops in exact proportion to those bonus shares you receive. So yes, you have more shares, but each one is intrinsically worth less.
Okay, let's take it a step further and see how a rights issue builds on this illusion. A rights issue lets existing shareholders buy more shares at a discount. Sounds like a great deal, right? But imagine a company is making a total profit of 300 rupees, and they have 100 total shares. Your earnings per share, or EPS, is 3 rupees. Now they do a rights issue and you triple your shares to 300. But the company's overall profit, still just 300 rupees. Suddenly your EPS completely tanks from 3 down to 1. The value is totally diluted.
Moving right along to illusion number 2, annual reports. Are these seriously only for chartered accountants? Look, there is a massive misconception that you need some sort of advanced finance degree to understand those terrifying 200-page annual reports, which, let's be honest, most people just use to cure insomnia. The reality? You really don't. You just need this simple 4-step cheat code. First, skip the AGM notice and all that self-congratulatory filler. Second, jump straight to the brand and product rankings. Third, read the management discussion analysis to see where the sector is actually heading. And fourth, and honestly, this one is absolutely crucial, always check the risk factor section to see what threats the company is realistically facing. Let's actually see this in action. If you apply those exact steps to the annual report of Zydus Wellness, you completely bypass the complex accounting and instantly uncover their massive brand strength. Within minutes of reading, you discover they are the clear market leaders in sugar-free, Nutrilite, Everyouth, and Glucon-D. Boom! You've just grasped the core strength of their entire business, and you didn't have to look at a single complex financial formula.
All right, on to illusion number 3, banks versus NBFCs. Are NBFCs really just weaker banks?
A lot of retail investors mistakenly think that non-banking financial companies, or NBFCs, are just second-tier banks for rejected borrowers. But that's not true at all. Think of a traditional bank like a massive wholesale vegetable market. It has all the bulk supply. Now think of the NBFC as the nimble street cart vendor who brings those specific goods right to your front door. They aren't doing the same job. They're serving entirely different functions within the exact same ecosystem.
But here's where the illusion gets kind of confusing. Banks get incredibly cheap money from our daily current and savings accounts. It only costs them about 2.5 to 3%. NBFCs, they don't have that luxury. They rely heavily on fixed deposits, which cost them around 6 to 7%. So if their core raw material, which is money, is more than twice as expensive, how on earth do NBFCs even survive the competition? Well, they survive because they are partners, not competitors. Banks have these massive piles of cheap funds, sure, but they lack the agility to distribute millions of tiny loans efficiently. So banks actually partner with NBFCs, essentially dumping huge funds to them. Why? Because NBFCs have specialized niche expertise, like in auto loans, they have much better door-to-door customer reach, and they use fast, tech-driven distribution that keeps operational costs super low. The bank is the heavy wholesaler, the NBFC is the nimble targeted distributor.
And finally, illusion number 4, Does a flood of IPOs actually mean we're in a healthy market?
There's this really widespread belief that when tons of new companies launch IPOs, the stock market is just booming and totally healthy. Actually, scratch that. Historically speaking, a massive flood of IPOs is often the exact setup for a market correction. It usually goes like this. Phase 1 starts with a strong bull market where everyone is making money. That optimism triggers Phase 2, where promoters rush to launch a flood of new IPOs to cash in on those high valuations. This leads directly to Phase 3, where massive amounts of retail capital, sometimes upward of 1 lakh crore rupees, gets diverted away from existing stocks just to chase these shiny new IPOs. And finally, Phase 4 hits. Starved of new investment, the prices of the existing stocks inevitably begin to fall.
To put it simply, here is the hidden mechanism at play. Retail investors only have so much cash on hand, right? So, to fund the purchase of these heavily hyped new IPOs, investors start selling their existing, fundamentally sound stocks. This mass action literally drains liquidity right out of the broader market. When the money supply abruptly shifts away from, say, 4,000 existing companies and pours into just 100 new ones, the overall market gets dragged down. It's just a classic, unavoidable case of supply and demand.
Which brings us to our final question for today's explainer. Are you building wealth on reality, or are you just buying into the market's illusions? Real wealth is built by seeing past the jargon. It's about understanding that a stock split isn't free money, knowing how to quickly extract value from an annual report, recognizing the vital symbiosis between banks and NBFCs, and spotting the red flags when an IPO flood hits the market. So, what steps will you take today to ground your investments in fundamental reality? Thanks for joining me on this explainer, and I'll see you next time as we continue to decode the numbers together.